Welcome to Breaking News to Trading Moves, and welcome to the debate. What if I told you that a trader who wins 90% of the time can be mathematically guaranteed to go bankrupt?
Well, a trader who, loses most of their trades can retire a millionaire.
It sounds backwards, right? But today, we are looking at the primary driver of long-term wealth accumulation in financial markets.
So the central question we are tackling is a mathematical edge, utilizing geometric optimization, the definitive determinant of trading success?
Or is strict risk management focused entirely on capital preservation and psychological discipline the true defining factor?
It is the classic tension between the exact math of making money and, well, the harsh practical reality of not losing it all in a panic.
Exactly. And my position is that maximizing geometric growth through a calculated statistical edge is the absolute engine of wealth. Without it, you are simply spinning your wheels in the mud.
And I contend that because theoretical edge is often an illusion created by flawed data, rigid risk management, and psychological survival are the paramount requirements, a mathematical edge is frankly useless if you cannot mentally survive the drawdowns.
You just lose your money a bit slower.
Right. You can manage your downside flawlessly. You can risk only 0.5% per trade, but a negative expectancy game will eventually drain your account to zero.
So where does the engine of wealth actually come from mathematically? It goes back to Gandil Bernoulli's 1738 paper. Bernoulli recognized that the value of capital depends on geometric compounding over time, not just static arithmetic averages.
Right. The geometric average is what actually ends up in your bank account.
Precisely. And that principle paved the way for the Kelly Criterion, calculating the exact optimal fraction for your position sizing based on verified win probabilities and payoff ratios is the mathematically proven method to maximize long-term wealth. You optimize the geometry of your returns, and the wealth naturally follows.
I come at it from a completely different angle. Theoretical mathematical optimization is inherently flawed in live markets due to parameter uncertainty.
You are talking about the quality of the inputs.
Yes, it is a textbook case of garbage in, garbage out. You can possess the most elegant Kelly Criterion model in the world, but your historical edge is frequently distorted by survivorship bias.
Because data sets often ignore delisted companies.
Exactly. They ignore the bankrupt companies painting an artificially rosy picture of market returns. Because market data is inherently untrustworthy, strict adherence to conservative capital preservation and meticulous psychological record-keeping are what actually separates successful market participants from gamblers.
I completely understand why you emphasize the danger of bad data. Nobody wants to build a strategy on a delusion.
Right. It is a recipe for disaster.
But we have to separate the execution of a strategy from the underlying truth of the mathematics. Let us talk about the Kelly Criterion, not by reciting the formula, but by looking at what it actually does.
Okay, walk me through our practical example.
Imagine a coin that lands on heads 60% of the time. Kelly does not give you a complicated theory. It just asks, given your 60% edge, what exact percentage of your bankroll should you bet to grow your money the fastest without going broke?
Well, because if you bet your entire bankroll on every flip, even with the 60% advantage, you will eventually hit a tailspin of tails and lose everything.
Exactly. You hit zero and the game ends. But on the flip side, if you bet a penny per flip, you are wasting the advantage. Kelly finds the mathematical peak of that curve.
It maximizes the log wealth?
Right. What it does is mathematically maximize the expected geometric growth rate of a portfolio. Risk management is merely the basic rules of the game. It keeps you on the board.
But it does not score points.
Exactly. Having an edge is knowing how to win the game. Think of it like building an airplane, a metaphor inspired by Bernoulli's own work in fluid dynamics. Understanding gravity, which is risk management, is mandatory to avoid crashing.
You absolutely have to respect gravity.
But respecting gravity does not make you fly. It is the aerodynamic equations of your edge that actually allow you to achieve flight.
That is a very compelling analogy, but consider what happens when your aerodynamic equations are fed false atmospheric data.
You mean the parameter uncertainty again?
Yes, the reliability of the inputs required for the Kelly formula is where the entire theory breaks down in practice. The math assumes the coin is exactly 60% biased, but the market is not a coin.
It is infinitely more complex.
Right. Let us look at survivorship bias in market indices, using the S&P 500 as a prime example. The S&P 500 is a dynamic, changing index. Companies are regularly added and removed.
So if a trader calculates their edge by downloading the current constituents
And backtesting them over the last 20 years, they are looking at a mirage. They are only looking at the winners who survived.
because the losers are scrubbed from the active list.
Precisely. They are quietly ignoring the dozens of bankruptcies, the Enrons, the Lehman Brothers, the companies that went to zero.
So the backtest is artificially inflated.
By a lot. If you only look at the surviving companies, a backtest might show a clean 15% annual return. Your Kelly calculator lights up, telling you that you have a large advantage.
But if you include the companies that went to zero,
The actual return might drop to 8%. Applying an aggressive Kelly bet to that false 15% edge mathematically guarantees gambler's ruin. You are over-leveraged on a phantom edge.
sure, raw data can be messy, but I see that as a research problem, not a math problem. Professional practitioners solve this through rigorous methodology.
How so? Because you cannot just magically find perfect data?
Well, they do not just download a free sanitized stock list. They use comprehensive premium databases, such as the Center for Research and Security Prices, or CRSP.
Which tracks the dead companies.
Exactly. That database meticulously includes delisted equities, bankruptcies, and mergers. You adjust the historical data to reflect the exact performance of those stocks up until the very day they were delisted. You put the losers back into the data pool.
But even if you source pristine CSRP data and build a perfect historical model, you are still assuming the future will mirror the past. And, the market environment is constantly changing.
Which is precisely why you do not just rely on a single historical backtest. You run Monte Carlo simulations to account for the variance.
Let us explain what that actually entails for the listener.
Definitely. A Monte Carlo simulation essentially creates tens of thousands of alternate universes. You take your clean, historically accurate trade data, and the computer shuffles the order of those trades randomly.
So it simulates different sequences of returns?
Right. It simulates what happens if you get your worst losing streak right out of the gate, or if the delistings bunch up together in one bad year. By repeatedly sampling the data set, you model the exact probability of different outcomes.
You build a distribution curve.
Yes, a distribution of performance metrics that accounts for that variability. Once the data is thoroughly cleaned and stressed through simulation, the geometric average remains the absolute truth for capital growth. You locate the optimal fraction and you execute.
I hear your point, but I just do not buy that perfecting the data solves the execution problem. Even with immaculately clean data and 1,000 Monte Carlo simulations, volatility drag constantly erodes capital in the real world.
Wait, let me pause you there. When you say volatility drag erodes capital, are you just talking about the psychological pain of drawdowns, or is there a mathematical erosion happening even if the trader never panics?
Oh, it is pure mathematics. Let us walk through a very basic scenario. Imagine you have a $100,000 account.
Okay.
You hit a rough patch, and your portfolio drops by 50%. You now have $50,000. To get back to your original $100,000, you do not need a 50% gain.
You need a 100% gain.
Exactly, because your capital base is shrunk. That is volatility drag in action. The more ragged your equity curve is, the more that math works against you.
So higher volatility equals higher drag.
Yes. If your Kelly formula tells you to bet aggressively, it creates large swings in your account equity. That standard error is unavoidable. That is why almost no professional actually trades a full Kelly allocation.
They utilize a fractional Kelly approach.
Exactly. A half Kelly or a quarter Kelly. Why? Because the parameter uncertainty is so severe. If you overestimate your edge by even a fraction of a percent and bet the full Kelly amount, the resulting volatility drag will literally destroy your account before the long-term probabilities have a chance to play out.
But using a fractional Kelly is just a conservative application of the exact same mathematical principle. It does not negate the math.
It proves the math is too fragile for real markets.
I disagree. It just applies a margin of safety to it. You are still utilizing geometric optimization. You are just turning the dial down slightly to account for the real-world friction.
But the very fact that you have to turn the dial down proves that capital preservation must take precedence over pure optimization. Consider Nasser Balsara's risk of ruin tables.
Those are fascinating.
They are. Balsara ran complex probabilities to calculate the exact chance of total capital loss based on three things: your win rate, your payoff ratio, and the percentage of capital you risk per trade. His tables show us the cliff edge.
And they demonstrate how delicate the entire ecosystem is.
Right. The tables show that even a minor miscalculation in your risk percentages drastically increases the probability of ruin. Let us say your optimal bet is 5% of your bankroll.
Which is fairly aggressive.
Very. According to Balsara, your risk of ruin might be near zero at 5%. But if you get greedy, or your data was slightly off and you bet 6% instead, you have not just increased your risk linearly.
The geometry works against you.
Exactly. Because of the way geometric losses compound, you have amplified your total risk of ruin from near zero to 30%. One tiny mistake in position sizing in a totally normal sequence of market losers will wipe you out.
But Balsara's tables rely on those exact same mathematical inputs: win rate and payoff ratio. You cannot escape the math. Let us look at the mechanics of payoff ratios to show why this is true.
Go ahead.
Say a trader has a 33% win rate. They only win 1 out of every 3 trades. If their reward to risk ratio is 1 to 2, meaning they make $2 for every $1 they risk, they perfectly break even over time.
The one winning trade pays for the 2 losing trades.
Exactly. To make money, you either need a higher win rate or a higher payoff ratio. This is pure structural mathematics. When traders maintain detailed trade ledgers, like Bennett McDowell's Trader's Assistant System, they are primarily doing so to refine these mathematical inputs.
You think it is just about tracking the numbers?
Yes, they track their gross profit, commissions, and running net profit to confirm they actually possess a positive expected value.
You are looking at McDowell's ledgers entirely as a calculator, but their true core value is psychological. The ledger forces a trader to confront their own human fallibility.
I disagree with that framing. The ledger provides the hard data to calculate the annual commission ratio, the average winning trade, and the average losing trade.
It does calculate those metrics, yes.
It tells you if your edge is mathematically intact.
But human execution is fraught with compulsive behavior. You are assuming the trader will flawlessly execute the math. Let us look at how people actually behave behind the screen.
You mean when emotions take over?
Exactly. Statistically, trading systems often exhibit trend exhaustion after 4 to 5 consecutive primary directional moves. What happens when a trader sees that exhaustion?
The math says, scale out, take profits.
But the human mind gets greedy. They fail to scale out because they want more profit. They want to hit a home run.
A failure to follow the system does not invalidate the system itself.
It invalidates the theoretical returns of the system in the real world. Or consider the opposite scenario. We have all been there staring at a red screen, sweating, manually dragging our stop-loss order down just to avoid taking the hit.
That is a classic mistake.
We hold a losing position out of fear, hoping it will turn around, rather than taking the small, mathematically calculated loss our system dictated. Theoretical returns do not survive human fear. That is why conservative risk rules are the only practical defense against ourselves.
So you view the ledger primarily as an accountability tool?
Exactly. McDowell asks specific psychological questions in his ledger system. Is it psychologically uncomfortable to see that you are losing? Is it more comfortable to postpone the news, maybe in the hope that it will correct itself?
It forces self-reflection.
These ledgers are mirrors. They are not just calculators. They expose when a trader breaks their own rules, like holding into a loss range they are not allowed to, or allowing the anger from a previous losing trade to affect their next entry.
It highlights the lack of discipline.
Right. That ledger is the cold splash of water that forces you to admit you are not trading a system, you are just gambling out of emotion.
I completely agree that psychological discipline is required to execute a trading plan. That is undeniable. However, discipline without a mathematical edge is entirely futile.
How is capital preservation futile?
Because you can be the most disciplined trader on planet Earth. You can meticulously track every emotional fluctuation in a journal and adhere perfectly to a strict 1% risk rule without ever moving your stop loss.
Which sounds like excellent trading.
But if your system yields a negative expected value, let us say a 40% win rate with a 1-to-1 payoff ratio, your discipline will only ensure that you lose your money in a slow, highly orderly fashion.
So it just prolongs the pain.
Exactly. Discipline protects the portfolio, but wealth accumulation simply cannot happen without a mathematically verified positive expected value and geometric compounding.
And my ultimate counter is that in an environment constantly plagued by hidden variables, survivorship biases, and continuous regime changes, theoretical mathematical perfection is literally unreachable.
You think the data will always betray the math.
You can never perfectly verify your expected value because tomorrow's market will not replicate yesterday's data perfectly. Therefore, rigid risk management and psychological fortitude have to be the most critical elements of market survival.
Survival being the operative word.
Yes. If you survive, you can adapt. If you optimize for maximum growth based on an illusion, you will eventually hit a sequence of trades that triggers your risk of ruin.
It is a persistent tension. You view the math as fragile because the inputs are inherently uncertain and humans are emotional.
And you view the math as the only reliable compass we have to navigate that exact same uncertain environment.
Exactly. Both perspectives are essential for a complete understanding of market dynamics. The relationship between statistical edge and capital protection offers ample material for further exploration.
We are left with the reality that markets demand both rigorous mathematical logic and extreme behavioral discipline. One cannot survive without the other.
Which brings us right back to our airplane analogy. You absolutely need the gravity of risk management to keep the structure from crashing into the ground. But without the aerodynamic geometry of a true statistical edge, you will never achieve flight. Thank you for joining us on Breaking News to Trading Moves. Until next time, consider what kind of structure you are truly building.